I'm very glad you're here with us. We're doing a follow-up. This is our big event for the quarter, where we're going to follow up on the success of our event from November. And back in November, we had 3,000 of you come and listen to a very interesting group of CEOs and thought leaders. And we talked about what we thought was going to happen in 2021. And we certainly addressed the pandemic and all of the issues that faced us. But there was something we didn't know. We didn't know what the outcome of the election was going to be. And today we do. So it's with great pleasure that we have Major Garrett at the end of this interview be able to sort of sum up where we are politically and where he thinks it's going to be going, because that's going to have a big impact on our business. We've been dead center of this storm from the get-go. So I appreciate everyone sticking with us. And today, we're not just going to hear from Major Garrett, we're going to hear from some industry leaders, CEOs, thought leaders, people who have an opinion on where this thing is going. We're going to talk about how the business of advising is going to change, going forward. We're going to talk about taxes and their impact and the potential impact on the environment. We're going to talk about the economy, and we're going to talk about, where the market's going to go. We're going to get a sense of what regulations are going to be coming, because that's for sure already changing, and where we're going to be in terms of the opportunities that are out there. So hopefully we'll end, with some real positive. We'll be able to take away some real positives from the event. So I'm very pleased to be doing this with you, and I wouldn't be a good publisher and editor if I didn't throw in a few additions for AdvisorHub here and talk a little bit about what we have coming up. We have a magazine coming, so please expect to see that at the end of this first quarter. It's very cool. We're very excited about it. It's a first of its kind. It's actually a flip cover magazine. On one side, it's AdvisorHub RIA. On the other, it's at the AdvisorHub magazine. And we're going to be able to get a little more in depth in some of the topics that you folks really care about. We have great partners already, so really expect it to be a lot of fun, and you'll see it every quarter, so that's going to be great. We also did a first of its kind industry culture study, partnered with Edward Jones, and the information in there is just fantastic. The things that we found out are going to surprise you, I think, and they certainly surprised me, and I've been doing this for a long time, so I'm actually pretty excited about that. We're also going to have more events like this. We're able to service you all in our community, because that's what you've asked for. We're going to have recruiting awards as well this quarter. So we're going to talk about and reward the firms with awards that have done so well in recruiting this year and last year, which was, surprising to everyone. I think was one of the best years in recruiting period that's ever been. So look, thank you for reading. I'm very excited about the opportunity we have here to be in front of you today. And like I said, we'll do more of this as time goes on. So I appreciate your support. We're going to hear first from Chris Mone, who's the EVP, and he's the head of wealth management services at Wedbush. He's a great speaker and a great guy, and he's going to talk about the business of advising. So I think this is going to be very interesting for all of us to hear what's going to happen next from our seats and how that might change. So with no further ado, Chris, thanks for being here.
One of my favorite lines that Tony used recently was when he called 2020 a dumpster fire. It's a great way to look back and label a difficult year filled with anxiety, fear, frustration, isolation, and put it all behind us as we move forward into 2021. But rather than writing off the year as a total disaster, we should be thinking about what we learned, what we can be doing as professionals more of, what we can do better, and some things we can do differently as we head into 2021. The lessons we learned last year will be the foundation of growth and our roadmap for success in the business of advice this year. One of the things that we all learned was how to adapt and improvise under periods of extreme stress and uncertainty. Here at Wedbush, we made decisions quickly, and we invested in new work-from-home or remote technology to protect our business and the health of our colleagues and our clients during this fluid pandemic. We made local decisions driven by our advisors and managers who had the freedom to decide where and how to best serve their clients. Many of our colleagues chose to work from home and continue to work from home, while some decided to continue to work in the office. We all changed how we served our clients last year, And we pivoted from a phone call or a face-to-face meeting to a new industry medium, Zoom, that was widely adopted during this pandemic in the work-from-home environment. Personally, I knew we had experienced a massive shift in our industry service model very early on. And it wasn't because I read a research report or an article or went to a SIFMA meeting where I learned about it. I knew it when my mom and dad sent me a link from their own Zoom account last April to host a call with our children. And when your mom has her own Zoom account, it's time to pay attention because change is here. So speaking of Zoom, my second favorite term that Tony uses is Zoom poisoning to describe the overuse of this new medium and the importance of setting boundaries to protect us from burnout. Many of us didn't believe that working from home was possible in the first quarter of last year. We never expected to rely so heavily on video conferencing, and it opened our eyes to a new possibility. It gave our clients better access to their advisors, better access to the ideas and solutions their advisors offered. There were new conversations happening all throughout last year. And who would have thought that this time last year, in January, that video communication would upstage our face-to-face meetings? That our clients may actually prefer a video conference over meeting in person? That it would expand our workday and, for many people, cause them to be more productive as a result? This time last year, many advisors were finalizing their 2020 business plans. And during the annual business planning process, it's normal to ask yourself, what if I did just a little bit more this year? What would happen? 3 months later, the pandemic hit, and it forced us to work smarter, to adapt, find balance, and avoid burnout. We had to go deeper with our clients to give them more. And we got better. I talk to our advisors at Wedbush almost every day and can share that they have learned more about their clients and their clients' families in the past 9 months than they've learned in the past 10 years. And I think that's an industry-wide experience. They're having better conversations, building stronger relationships, and as a result, they're exceeding their own expectations and the goals they set last January in their business plans. So the business of advice in 2021 comes down to asking yourself a simple question. What can I do more of, differently, or better for my clients in 2021, based on what I learned last year in the new abnormal of 2020? Our best advisors at Wedbush Securities are forging deeper relationships with more clients, more client-facing time, and they're building trust and demonstrating competency in those better client meetings, which are often 10 times more frequent than they happened in the past. And because of what happened and what we learned from last year, we know that clients will continue to require more from us. We'll need to be better at meeting their expectations, and this will require us to have different conversations in 2021. So here's a simple self-assessment. 5 questions to ask yourself on what you can do more of, better, or different this year. And when you answer them honestly, they can form the entire foundation for your 2021 business plan. So number 1, what do my clients need from me and what do they expect from me this year? Number 2, how will I ensure that the first call with any question that a client has with a $sign attached to it comes to me? Number 3, what are 3 things about that my clients are worried about right now that I can address? Number 4, where do I need to get better educated? Do I have a capital markets outlook for 2021? Do I understand the relevant tax and estate planning concepts my clients are going to ask me about because they're worried about them? And number 5, who can I rely on or reach out to for help? Ask your firm to host a Zoom call with a subject matter expert. In March of last year, we hosted a video conference with a well-known industry psychotherapist. It was a different type of call, but this professional shared some terrific insights with our advisors on managing the hard conversations with clients and preparing them for what was to come. The insights from that call gave our advisors the ammunition and prepared them for a much different client conversation throughout the pandemic, where empathy was just as important as performance reporting. In addition to the self-assessment, I recently shared 3 things every advisor should be doing right now to build trust and demonstrate their competency with their clients to underscore their value. So here they are. Number 1, identify gaps in your practice. You have to become a subject matter expert, or at least conversationally fluent in the rules around estate and gift taxes, around the potential for an elimination of a stepped-up basis at death, or any of the other concerns your clients have impacting their wealth, their children, or their grandchildren, including their current estate plan. You've got to learn what's keeping them up at night and be able to address it. Number 2, educate yourself. Ask your clients what they're worried about and what is keeping them up at night. Host a client advisory board meeting and ask your top clients, what are they worried about? What's causing them anxiety when they think of the markets and the political landscape? What are their peers and colleagues worried about? And keep an inventory of their responses so you know what issues are top of mind for your clients and prospects. And then reach out to the centers of influence you work with currently, the experts in your community, CPAs, attorneys who are fluent in taxes, trust, and estate planning. Work with them and they can help. Perhaps even some of your wholesalers you work with have experts that they use on the political landscape that can help you get educated there. And finally, number 3, you've got to embrace digital solutions. I mean, this one is obvious. I think we all learned last year you cannot ignore this change that's happening, and if you do it at your own peril. If you're feeling vulnerable, like you've been left behind, if there's nowhere to hide in a 24/7 access on demand service world, it's time to take action. You can't ignore this one. You need to master the art of the video introduction. This new medium has disrupted the awkward ask of a client for an introduction to someone they know that you can work with. There's a whole new way of doing it today, and you need to do your homework and educate yourself. Learn more about how to use video to build your practice and expand your reach. As you're doing it, you can rethink your marketing efforts and consider hosting client events with your COIs. A cottage industry has sprung up around making Zoom calls fun with wine tastings and painting lessons. There's so many new and innovative ways to market your practice, connect with clients and prospects, and articulate the value of your relationship in your practice. The business of advice is not going away, but it may continue to change or adapt. And I continue to hear our advisors at Wedbush say that this has been their best year in the business, that they have better client relationships, more introductions, and will continue to embrace a totally different environment this upcoming year from the lessons they learned in 2020. And we hope that you will too. Thanks for listening, and we appreciate your tuning in.
Well, we're very glad to next have Paul Dietrich. He's the Chief Investment Strategist for B. Riley Wealth Management. You also know him from TV, from Fox News and CNBC, and he also writes a weekly column for us that you can read and talks about the economy. He's a very popular writer with us, so we're happy to have him talk about where we're going to go from here, especially now that we've got the election locked up and what that might mean going forward from point of view of the market and one of the top economic strategists in the country. So thanks for being here, Paul, and welcome.
Hi, my name is Paul Dietrich, and I'm the Chief Investment Strategist at B. Riley Wealth Management. At B. Riley Wealth, we manage over $11 billion in client assets. You know, if someone had told me a year ago in January that the United States would experience a 100-year plague, politicians would shut down the entire U.S. economy, the stock market would crash to Great Depression levels, unemployment rates would skyrocket, we would have a trade war with Canada, Mexico, Europe, and China, gross domestic product would plummet, and rioters would ransack and take over the U.S. Capitol at the encouragement of a U.S. president. And after all of that, the U.S. stock market would still end up climbing to all-time historic highs. If someone had told me that a year ago, I would have thought that person was insane. Well, you know, 20 years from now, how will historians write about 2020? The coronavirus pandemic, will obviously dominate the way we look back on this past year, not just as a 100-year plague that sickened the world and caused millions of deaths, but as an event that completely changed the trajectory of political, economic, and cultural trends for years to come. COVID may not have created trends, but it did accelerate already existing trends. To fight COVID, for the first time in U.S. history, American politicians shut down the entire U.S. economy, forcing a brief major recession. While the stock market and most of the underlying economy bounced back quickly, COVID hammered people at the lower end of the economic income scale, and it's going to take years for them to recover. There are a lot of cultural trends. COVID also laid bare many of our U.S. cultural divisions that have been festering for years. Americans found ourselves living in an era of a poisonous political division on par with the 1790s, the 1850s, or the late 1960s and early 1970s, when neither side was willing to acknowledge the other's way of looking at the world was legitimate. And they considered the opposing views a fundamental threat to what each side held dear. These political divisions reached a crescendo with the rioting and deaths at the attack on the U.S. Capitol. A lot of healthcare trends have changed. COVID will be remembered as having nearly destroyed our hospitals and national healthcare infrastructure. It's laid bare the shortcomings and institutional paralysis of our federal and state public health infrastructure like the CDC, the NIH, FDA, and Health and Human Services departments. And without COVID, the presidential election outcome would probably have been very, very different. So, we look at all of this together, and how will the new Biden Democratic policies affect the economy and the stock market? It will still be challenging to get anything controversial through a 50-50 Senate, even with Vice President Kamala Harris as the tiebreaker. You have to remember that there are still 4 or 5 conservative Democrats like Joe Manchin of West Virginia, Senator Kyrsten Sinema of Arizona. These people all occasionally vote with the Republicans. And even with Senator Schumer as majority leader, the center of power will shift to several individual conservative Democrat and moderate Republicans like Romney of Utah, Sass of Nebraska, Collins of Maine, and Murkowski of Alaska. Both parties' moderate senators will hold almost as much power as McConnell and Schumer on every piece of legislation, because just one vote could change everything. It will only take 1 or 2 of these senators to swing a vote one way or another. Every individual senator always has more power in a narrowly divided Senate. So here's what Biden can't do. Everything investors were worried about in a Biden administration will now happen with a closely divided, well, it will not happen with a closely divided 50-50 Senate. It would take a 60-vote majority to pass any of these initiatives. I mean, there's not going to be any Medicare for all. There's going to be no court packing. This would require all Democrats to agree to abolish the 60-vote filibuster rule. Biden is against doing this, and 4 Democratic senators, including Senator Manchin and Senator Sinema have stated that they would vote against that rule change of getting rid of the filibuster rule. There'll be no Green New Deal because of that, no anti-Second Amendment gun legislation, no defunding the police. Most Democrats, including Biden, are opposed to that legislation. There will be no getting rid of coal, oil, natural gas, or fracking. The Senate Energy Committee is going to be chaired by Senator Joe Manchin, who's in West Virginia is known as King Coal. So enough said about that. There'll be no move to make Washington, D.C. and Puerto Rico states. You'd have to amend the U.S. Constitution to do that, and that would take not only a 60-vote margin in the Senate, it would require 2/3 of the states to approve that kind of constitutional amendment, and a majority of the states have at least one legislative chamber controlled by Republicans. This is never going to happen. So let's just take a look at 2021 and what we can see going forward in the U.S. economy and stock market. It is hard to look forward to 2021 without at least a glance backwards at 2020. The major economic story of 2020 was the pandemic. Political and economic events exposed a deep fissure between Main Street and Wall Street. You know, few big companies suffered much financial damage due to the lockdowns and virus, and big tech has allowed most of the economy to operate virtually. Still, damage to small service industry businesses has been very dramatic. Many of those Main Street businesses will take years to recover, if they ever recover. With the election now over, Americans can turn their full attention to fighting the virus and implementing an effective national vaccination program in the first 3 to 6 months of this year, and then focusing on the economic recovery through the rest of the year. After the first quarter, we should start to see solid performance and strong corporate earnings pave the way for continued gains and an eventual return to some semblance of normalcy. Even though U.S. stocks ended the year at all-time highs, many analysts see the S&P 500 index rising further in 2021, driven by a more robust economy, healthy profit growth, interest rates remaining near zero, and massive Federal Reserve and government stimulus and infrastructure programs. They also expect the stock market's leadership to broaden beyond the largest tech stocks to include financials, industrials, and other economically sensitive shares that were left behind in 2020's rally. So if we can just get through the first quarter of 2021, according to CDC epidemiologists, the nation's healthcare infrastructure and hospitals are on the verge of being overwhelmed. We are now seeing lockdowns in California, New York, and other states. Ambulances, in some cases, wait in lines for up to 18 hours to drop off patients and find them beds. And as hospitals around the country are imploding, there's no question that we could possibly see more lockdowns in the next few months in various major cities. I don't think we're going to see a nationwide lockdown, but we will see more in a lot of cities. It's very possible that we could see a pullback or correction in the market while we are waiting for America to get vaccinated and getting more vaccines out and the economy back to some semblance of normalcy. So what can we expect from the stock market after the first quarter? In the long term, I believe that the market will thrive in 2021 due to the expected 4.4% to 5% GDP growth that's expected by most analysts in 2021. The new COVID-19 vaccines are expected to return the nation to some semblance of normality by the late summer or early fall. The CDC believes the strain on the healthcare infrastructure will start to abate in late March, early April. And the new Biden stimulus legislation, which is up around $1.9 trillion, combined with the expected $2 to $3 trillion in infrastructure legislation that is expected to pass in late February, early March, that should make 2021 an excellent year for the stock market after the end of the first quarter. Investors were clearly challenged like never before in 2020 as the coronavirus took the markets from record highs that marked the start of the year to the brink of depression by the end of March, and then back again to record highs, near the end of the year. So almost every day, as I speak to investors, I can hear the concern and anxiety in their voices. They just couldn't figure out how the stock market would react to the virus. They couldn't figure out the market crash in March, the impeachment, the elections, the riots at the US Capitol. In many cases, there's no historical precedent for what happened in the last year and even in the first part of this year. The more I think about it, that is why it is so vitally important that an investor partner with a trusted financial advisor in times like these. 2021 will not be any different. Clients, smart clients, are going to need an advisor more than ever. And what we have gone through is not what we expected at the start of last year, but it is so much better than it might have had. And that will be the story in 2021.
Thank you, Paul. I am thrilled to have Kurt Mashinsky. He's a founding partner, president, and CEO at Cerity Partners, and which is a great firm, a $30 billion RIA firm. The great thing about Kurt, other than being a really nice guy, is that he's a CPA. So the firm has a lot of family office opportunities in it. And the great thing about having him talk is he's going to talk about taxes and what that environment is going to be for clients and advisors going forward. And I think that it's something that concerns everybody. It's going to concern all of our clients. And I think we'll come away with some good points here on how to handle the new tax environment. So Kurt, you're next.
Thank you, Tony, and AdvisorHub for inviting me to participate today. And hello to all AdvisorHub viewers. I have the privilege of leading Cerity Partners, a national full-service wealth management firm providing estate, financial, tax, and investment planning advice to over 6,000 wealthy individuals and their families. I cannot recall entering another year of my professional career that posed more uncertainty for and provided a better opportunity to demonstrate the value of holistic financial advice to clients than this year. Given the current economic and political environment, a key question on the minds of many wealthy individuals is, will there be tax reform and higher tax rates this year? Reasons that wealthy individuals should be concerned of such potential tax reform include a prolonged global pandemic, a tenuous economic recovery, mounting U.S. debt in both nominal size and as a relationship to GDP, a new administration, the Democratic Party's control of the administration, House, and Senate, President Biden's campaign position on tax policy reform targeting wealthy individuals, funding for another economic relief package, and potential funding for bipartisan supported initiatives such as infrastructure, just to name a few. So how can we assess the potential for higher tax rates and help our clients plan accordingly? Well, a good first place to start is understanding President Biden's proposed tax reform policy targeted at wealthy individuals, which includes increasing the highest ordinary income tax rate from 37% back to 39.6%, increasing the long-term capital gain and qualified dividend tax rates for taxpayers earning more than $1 million from 20% to 39.6%, in addition to the 3.8% net investment income tax, which nearly doubles taxes on long-term capital gains for these taxpayers. Reinstating a tax deduction limitation on certain itemized expenses that existed prior to the 2017 Tax Cuts and Jobs Act, which limited the tax deduction to 28% of these expenses. Imposing a 12.4% Social Security payroll tax on earnings above $400,000. Currently, such a tax is only imposed on earnings up to approximately $143,000, in which half that tax is paid by an employer and the other half paid by the employee. Repealing the step-up in tax basis for inherited assets. Also allowing the current lifetime estate and gift tax exclusion amount of approximately $11.6 million to sunset in December of 2025 as currently planned and revert to pre-2018 levels indexed for inflation, which will likely make that exclusion amount approximately $6.5 million or more, but nearly halving the amount from where it is today. Also restoring the estate and gift tax rate to historic norms. Unfortunately, President Biden did not quantify in his policy position what historic norms are. And lastly, eliminating the preferential tax treatment of carried interest, a potential change affecting professional venture capital, private equity, hedge fund, and real estate investors alike. Well, the next step to assessing the potential of higher taxes for our wealthy clients is understanding the likelihood of tax reform actually being enacted, which can be generally accomplished in one of two ways. First way, the House must pass a bill with a simple majority or 218 votes before sending that bill to the Senate for a vote. The Democratic Party currently controls the House with 222 seats. Unlike in the House, any bill can be indefinitely delayed in the Senate with a filibuster, and a filibuster session can only be stopped by a 3/5 vote of all sworn-in senators, or stated differently, 60 senators if there are no vacancies. If a filibuster on a bill is ended with a vote of 60 senators, the bill will be sent to the Senate floor for a vote, which only requires simple majority or 51 votes to pass. The Senate is currently split with 50 Democratic and 50 Republican senators, in which Vice President Harris can cast the deciding vote. As a very important relevant aside, there is also a parliamentary procedure that allows the Senate to override a standing rule of the Senate, such as requiring 60 votes to end a filibuster through a simple majority vote. This procedure is commonly referenced as the nuclear option and is infrequently invoked, but often threatened. The second way in which tax reform may be enacted is through a procedure known as reconciliation in the budgeting process. Because the debate time for reconciliation is statutorily limited, the Senate cannot indefinitely delay the reconciliation with a filibuster, and therefore, under reconciliation procedures, the tax reform proposal would need only 51 votes in the Senate for approval. Although at the current moment, we do not know for certain whether tax reform directed at wealthy individuals will be a priority for President Biden's administration in 2021, considering the president's desire to lead the U.S. out of a global pandemic, stimulate the economy, decrease unemployment, and pursue bipartisan initiatives, there appears to be much political desire and ability within the Democratic Party to raise taxes on companies and wealthy individuals while the Democrats control the House and Senate. So how do we best prepare and advise our clients for likely, but not guaranteed, higher tax rates? A first good step is to scope the problem and assess the potential impact on each of your clients, whether you are a holistic financial advisor or more narrowly focused on investment management. helping your clients assess the financial effects of higher taxes, and more importantly, develop a plan to reduce their current or future tax liabilities, will demonstrate much value for the fees that they pay to you. So for each client, take 4 notes of inventory. First, their current and future expected annual taxable income. Second, their recently realized capital gains and the total amount of short and long-term unrealized gains. Third, their 2019 tax return, and if possible, a 2020 or 2021 tax projection. And lastly, their current taxable estate value. With that information in hand and the belief that there is good potential for, but no certainty of higher tax rates, consider the merits of the following planning ideas. Immediately assume higher contingent tax liabilities into your estate financial, tax, and cash management planning. Sell appreciated investments with meaningful long-term gains, remembering that the 30-day wash sale rule does not apply to capital gains, only losses. Reassess all decisions pertaining to your clients' incentive equity holdings, such as vested stock and options in their company, and other benefit plan elections, such as the amount of their disposable earned income that they are deferring into qualified and non-qualified retirement plans, such as a deferred compensation plan. Begin reevaluating their asset allocation, asset location, and holdings with a whole new tax lens. Consider deferring, reducing, or possibly eliminating capital gain tax liabilities by investing some or all the amount of capital gains recently realized into qualified opportunity zone investments. Also, consider deferring, if possible, incurring certain expense deductions or making certain donations until tax rates increase. And lastly, revisit trust and estate plans. Assess planning strategies that provide maximum flexibility in controlling the amount and type of assets that will be irrevocably transferred out of your client's taxable estates. Although there are many other and more complex planning ideas that are relevant for certain client profiles and situations, the ones that I just mentioned are universal and will immediately begin a productive dialogue with clients, and more importantly, demonstrate your ability to provide much value-added advice beyond simply investment management. I hope you find value in some of these observations and ideas, and I wish you much continued success in advising your clients. Tony, I'll stop there. I'll now hand it back over to you.
It's my great pleasure to introduce our friend Ron Kruszewski. He's the CEO and chairman at Stifel Financial Corp. He's also the longest serving CEO in our industry. He and I have talked many times and interviewed him many times with you all, as you know, watching. He just has a really good perspective on our industry and where it's going. And it certainly reassures me when I hear from him. And he can talk using his worlds of experience and talk about what's going to be next. Ron's going to talk about regulation. He knows these new regulators coming in. He knows them well from experience because he's been here and he's worked with them in the past. I'm really looking forward to his point of view on that. But as always, I know Ron's going to point out the opportunities as well, where we can take advantage of this new environment. So, Ron, thanks for being here, and look forward to your talk.
Good afternoon. I'm pleased to speak at your 2021 Outlook. I want to thank Tony from AdvisorHub for inviting me to share my thoughts. And what I thought I would do today is just talk to you briefly about a couple of things that are on my mind. I want to talk about my view of the economy, the regulatory thoughts that I have with what might change in 2021. Talk a little bit about tax policy and how we all should be thinking about that as we advise clients. And then maybe finally, what are we at Stifel telling our advisors and what to do in this environment. So first of all, let's talk about the economy. After the election, we at Stifel had targeted that the S&P 500 within 6 months would be at 3,800. And lo and behold, that's where we are. So from our perspective, we haven't raised our targets in the equity markets. We believe that markets are fairly valued. I mean, for those of us that have been around a lot, when you see 25, 24, 25 times earnings, that tends to give you a feeling that the market is fairly valued. And I'll tell you, as I look forward, though, I'm optimistic about 2021. And I'll give you a couple of reasons why. But I want to say up front that the very things that make me optimistic about 2021 are the same things, ironically, that make me concerned long term. So first of all, when you think about the economy, the two, or maybe the one overriding factor besides the pandemic, and I don't want to minimize the pandemic, and of course, I should say that I hope everyone is safe and well. But we're going to get people vaccinated. There'll be a time when I believe this pandemic will be behind us. So if we just set that as an ongoing issue, what is the thing that's driving this economy? What I would say is it's stimulus. It's both fiscal and monetary stimulus. So the Biden administration has proposed 1.9 trillion of additional stimulus on top of 900 billion that was passed in December, and that's on top of 2.9 trillion, give or take, last March, April. So that's $5 trillion of stimulus. That's 25% of GDP. That's a big number. And in my view, that has actually overcompensated the overall economy and maybe the overall consumer for what was lost by the shutdowns. And so that means it's very stimulative. I do want to say that I do think there are people suffering. I do think that the stimulus could be more targeted, but for purposes of just continuing this conversation, let's just talk about the overall impact. So you have $5 trillion of stimulus plus monetary policy, which has driven interest rates to zero, negative real rates, and quantitative easing, which I believe is totaling 120 billion a month. I mean, when Bernanke was really trying to deal with the financial crisis, I think he got to 80 billion a month. So the amount of fiscal stimulus and monetary stimulus, I think, are sort of at max capacity, so to speak. And that's driving this market, will continue to drive this market in 2021. The other thing that I think you're going to see is a tremendous amount of pent-up demand. If you listen to Chairman Powell now a week and a half ago, he coined a term that I'm going to use here, and maybe some of you read this, and it was that he saw exorbitant spending, the possibility of exorbitant spending. And what he was referring to was that when the pandemic gets done, people of the American consumer has been saving a lot, have not been traveling, and you could see just a tremendous demand for airplanes, vacations, travel, going to restaurants. And what could that mean to the supply chains of all this? I mean, if everyone wants to go to a restaurant, the pandemic's closed 30% of our restaurants. So when you take all of this into consideration, I think that 2021 is going to be a year of stimulus plus demand plus the getting through the pandemic, which is going to sort of supercharge GDP. And you see a wide range of GDP numbers. I think the market and the economy is going to be very strong. Now, what's that mean for the markets? Again, the comment of Powell, and I'm going to take a little cautionary tone here, but when I heard exorbitant spending, of course, what did I think of? I thought of in the late 90s when then Fed Chairman Alan Greenspan said, irrational exuberance. That actually predated the tech crash, so to speak, by, I believe, 3.5 years. So when I said that the very things that make me optimistic about the short-term market are the same things that concern me about the long-term market, and that is that stimulus, and both fiscal and monetary stimulus, we all know that trades like that balance. They will balance themselves. And the long-term balancing of this stimulus, I believe, will be some deflationary aspects in asset values. I think a lot of asset values are being pumped up by all of this money and liquidity. So, again, I'm optimistic short-term, concerned long-term, but I think as investors, we should look at the economy as an opportunity. One of the things that I may be concerned about is the fact that everyone seems to say that interest rates are going to stay zero or very low for very long. Whenever the consensus believes that, I tend to get nervous. So I think one of the real risks to this market would be inflation expectations, which would cause rates to rise and the Fed to maybe preemptively raise rates. That certainly would not be good for growth stocks. That would probably be better on relative for value stocks. But that is a risk that we should be thinking about. Of course, everyone's been saying, inflation's a risk for the last 5 years, that it can't possibly be a risk. I'm reminded that house values always go up. We don't have a problem with any housing either. So I believe that is a risk that we need to be aware of. From a client point of view, I believe that we need to be careful in credit. A lot of clients are reaching for yield, and the credit spreads have never been tighter. So these are some of the warning signs that I see in the overall economy, and I just wanted to share them with you. On the regulatory front, I'll just make two comments. They sort of lend my thesis about the market. First is I'll speak to the two primary regulators in our business, and that would be the Treasury Secretary, so Treasury Secretary Yellen, and then the SEC Chairman, Gary Gensler. I know, and I've known Treasury Secretary Yellen for nearly 7 or 8 years. I served on her Fed advisory board for, I believe, 5 years. And I just know her, first of all, besides being just a fine person and very intellectual and knows the markets. She also, though, is, I would say, dovish. So she would be supportive of fiscal spending, and maybe fiscal spending in a big way. So I think that you're not going to see a hawkish view out of the Treasury Department at all. But I think we have a good steward in Treasury Secretary Yellen. On the SEC side, I don't know Gary Gensler as well. What I would suspect from what I've heard and what I saw when he was chairman of the CFTC is that you're going to see more enforcement and stronger regulation. And I think as it relates to the people on this call, that will primarily circle around Reg BI and what's going to happen in Reg BI in terms of maybe stricter interpretation and guidance and enforcement versus maybe even a possibility to try to rescind Reg BI. But I do believe that's what you'll see, and most of what we'll deal with is regulatory versus legislative. The other, so the regulatory front is not something that I'm overly concerned about. Speaking at Stifel, I've been CEO here now for 25 years, 2 Democratic administrations, 2 Republican administrations, and now another Democratic administration. We will be fine, and all of us will get through the regulatory aspect. One of the things I think a lot about is tax policy and what will happen. So a lot of the tax policy questions, many people think that there aren't the votes, you can't, the filibuster will probably stay intact. So how do you actually pass tax increases? Well, the answer is they'll do it in reconciliation. That's a simple majority. think they'll link it with an infrastructure bill. So what are the things that we should be thinking about? There is it's going to take some compromise even to get 50 senators to go for this. Remember, Mark Kelly in Arizona is up in 2 years. Joe Manchin is not. He's not been a big fan of the stimulus, the additional checks. So I'm not sure it's even easy to get to a consensus among the Democrats, let alone the Republicans. But what I do think will happen is we will see an increase in the corporate tax rate, probably with an infrastructure bill. That'll take corporate rates, to probably the middle of the range, 25, 26%. Not sure the market's completely discounted it, but it's probably not that big of a deal. The bigger deal for your clients, though, I believe, will be how we and how you advise your clients to the potential of an increase in capital gains taxes and changes in estate tax planning. And so, in summary, dividends and capital gains could go from 20 to 40%. And estate planning, Senator Sanders has, shall we say, some interesting ideas that include elimination of step-up in basis, a rollback of the Trump exemption from 11.5 million or a little bit more today to maybe, I've heard things down to $1 million. And those are things that I believe we need to be talking to clients about today. The idea of planning your estate and understanding what can happen, because often some tax policies, if they're going to be changes, the effective date, I don't believe things will get rolled back to the first of the year, but the effective date will often be the date the legislation was introduced. So that's something that we should be really, really talking to our clients about, how we position for an increase in taxes, which would, again, corporate rate going up, cap gains and dividends doubling, and then the estate tax exemptions going away, let alone step up in basis, eliminating it. If you think about it, if you have no basis in stock, and what they're talking about raising the estate tax from 40 to 50, you could, on an incremental basis, pay cap gains and no step up. And then if you die, and then have an estate tax, you're talking 75% estate tax. The combination of the elimination of the step up and increasing the tax. So clients need to be aware of that. So what am I talking to our advisors? What are we emphasizing here at Stifel? Well, first, what I'm just talking about, get educated about these things. You have to understand and be on point with respect to these issues. The ignorance is no excuse, never was, by the way, but in this particular time, to understand the interplay between estate taxes and tax reform and the markets, I think is important. Because of that, and because of the need to understand these issues, that's the same advantage that we're all going to have, and that people will want advice. They want advice. So if you become educated and your firms give you the tools, you will be able to talk to clients about things that really matter and that are relevant and that are happening right now. So good advisors are going to flourish, and advice will be king. Order taking, buying stocks online, that's a commoditized business. That is not what people are going to want to be talking about. They want to be talking about goals-based planning and understanding how a new administration and new policy may impact their investment portfolios. So look, markets are going to be volatile. If they weren't volatile, we wouldn't have, the kind of great careers and interesting careers that we have. It's helping our clients prepare for change and volatility is where we add value. And so, if anything, the uncertainty of 2021 and there are a lot of uncertainties, that is opportunity. That is where you and our industry, the advice industry, can, and I believe will flourish. So I want to thank everyone for letting me talk a moment. I don't want to take up too much of your time. I understand we've got some great speakers today, and I look forward to talking, maybe meeting a lot of you sometime in the future. So have a great day. Thanks.
Major, you there?
There we go. Hello?
Major?
Yes, I'm right here.
I don't see your face. I had to hit a thing on there that said start video and unmute. This is the kind of high-end technology that we have.
Right. So let's see. Where do I?
You have to tap your thing, and on the bottom, tap your little
Start video.
picture.
There we go. There, the icon finally came up. There we go.
Oh, there we are. See, this is the kind of high-end technology. If you came to work for us, Major, I can guarantee you this kind of quality environment all the time. I'll even get you your own cell phone if you choose.
Oh, wow. My own cell phone.
FYI.
Imagine that.
There's a lot more to it than that. There's a lot of emoluments. You'd be surprised, but that's the major one. And then this kind of tech.
Right.
Yes. So, hey, look, I'm thrilled to have you here. For those of you who don't know, it's Major Garrett, the chief Washington correspondent for CBS News. Thrilled to have you, so, and very glad. And boy, there's a lot to talk about. We've had this dumpster fire that is 2021. Our business has been dead center. Major. We've got. Other than people's health, they worry about their money, right,
Sure.
and their wealth and their family legacy and stuff. So we've been sort of right in the middle of it, and of course the pandemic has affected our business. And then the other thing that's affected our business tremendously is politics, and especially today, what we've been through. What's going to happen in 2021 is, what's the future of the Republican Party? You should have all these answers. What do you think?
Oh, yeah. What's going to happen in 2021? Well, wow. Look, I think the best way to think about 2021 is the way you naturally think about your own calendars, quarter by quarter. Yeah. We have to get the vaccine situation improved. And everyone I talk to, and I do a weekly documentary podcast called The Debrief. And my topic this week, it came out just Tuesday, comes out every Tuesday, is on the vaccination rollout. What went wrong with it and what needs to go right? And there was an announcement yesterday by the White House buying more doses. That increases supply. That's one dimension of it. But all the choke points between the federal government and the vaccine suppliers, getting them to the states, and then once they're in states, getting them to the cities and counties, public health officials, having enough vials, having enough people to vaccinate people, all those other things need to be teased out. And they need to get much better rapidly in the first quarter. And if they do, that is going to do two things. One, it's going to increase confidence in our ability to carry out the rest of the vaccination program that's going to need to flow through the second and third quarter of the year. But if we're uncertain at the end of the first quarter, then all the economics around, oh my gosh, we're not going to get this done, it's not happening fast enough, are going to create a downward sense of psychology about where the economy can be as the rest of the year goes on. So we have to ramp up and get the vaccine better. The administration has also prioritized testing. And if you've talked to anyone around the country, as I have, about places where testing exists and testing is rapid, lots of good things can happen. And where testing isn't available and isn't rapid, those things can't happen. A classic example, I was doing an interview this morning for next week's podcast, The Debrief, which will be on disinformation, QAnon, and the like. Yeah. And I was talking to a professor at the University of Illinois in Champaign-Urbana. I said, are you doing in-room classes? And she said, yes, we've been doing it all semester. I get tested twice a week, and the test results come back in 12 hours. So we can do this because they have what? A ready supply of rapid testing. Yeah. If those two things, vaccination and testing, do get ramped up, are more coherent and available, so many other good things are going to flow from that. Not just getting back to work, but getting back to school. And once kids go back to school, their parents can work and focus more. We can go out and dine more. We can maybe go to a live concert or some kind of live event with a greater sense of confidence. And a lot of these other things, which the previous discussant was talking about, that pent up demand starts showing up. So all these things that we want to get better are dependent on the first quarter of 2021. And if we do improve these things, squeeze out the bottlenecks, simplify things, get better databases, more visibility, more testing, more vaccination, then quarter 2, quarter 3, and quarter 4, all will get, I think, not exponentially better, but noticeably better from an economic perspective.
Yeah, it's interesting because what you're saying is, listening to everybody before, we've had economists, CEOs that are CPAs talking about taxes. Everyone's kind of making the assumption that we're going to get our arms around it in the first quarter. And that's the basic assumption that all of this relatively positive economic forecasting that people are doing for 2021 rests, like we're actually going to have to do this.
Right. And there are tremendous incentives to do this. Every governor has an incentive to do that. You've got to get your economy back up, and you've got to get your hospitals and public health systems that have been stressed for a full year on better footing. Everyone has an incentive to do this. And as I talked to people about what went wrong with the vaccination thing, it wasn't as if people tried to stumble out of the blocks. It was just a lot to try to do, and unrealistic expectations were created. When the Trump administration said in December, 20 million shots by the end of December, 50 million by the end of January, I'm telling you, they knew that was not possible. It just wasn't possible. And that set unrealistic expectations. And that's a dangerous thing in the economic world or political world. And I think one helpful thing, whether you like Joe Biden or not, Joe Biden is a bit on the look, this is going to be harder before it's going to be easier. And we've got to get things more correct than they currently are, or things are going to stay bad. That's actually helpful in setting expectations and incentivizing and pressurizing the system to get better at what it's not at currently.
Well, it feels like somebody's steering the boat a little bit now. I mean, that's just the basic part of it. Someone's on top of it. Someone's paying attention to it.
And someone is prioritizing data. It's very clear that the Trump administration did not want to prioritize COVID-19 data because it was a downer. And I spent 5 years around the Trump campaign and then the Trump presidency. And if there's one thing that Donald Trump hates, it's downers. He just doesn't like it. His whole mentality is about positivism. Excessive, relentless positivism. And COVID-19 was a total downer from beginning to end. And we've learned what happens when positivism becomes a philosophy that overstrips science and data. And I said, when this thing just started in March, remember the Oval Office address President Trump gave? We had special report coverage on CBS. I turned to Norah O'Donnell. I said, this is going to be the greatest challenge of the Trump administration and President Trump, because this can't be tweeted away. It can't be humiliated, and it can't be bullied, and it can't be intimidated. The virus doesn't care about the president's Twitter account. It just doesn't. And if the president and his people don't wrap their minds around that they can't talk or create a theatrical or other kind of reality response to it, it's going to persist no matter what. They're going to have a big challenge with it. And I was proven correct.
Well, and part of this is also, you think you want to, you can't talk your way out of a virus. I get that. But what happens now to the Republican Party? What happens in next year when a guy who's like, look, without the virus, you can make a pretty good argument this guy would have won.
I can make an argument with the virus he could have won.
Yeah, right. I mean, it was close. And, we need a two-party system, right? I mean, we have to, that's good for everybody to have a two-party system. But boy, this is just, it's a train wreck. And you and I talked a little bit about this, but it seems pretty tough.
Well, the Republican Party is, for all intents and purposes right now, a deeply Trump-influenced party. I won't say it's an entirely Trump party, but there are those who deeply support the president, admire what he did, who prefer to call themselves Trumpicans or some variation of that, taking the sort of Republican Party name off and making sure the Trump brand is in there. That's a testament to not only his approach to politics, his approach to communication, but his long-term approach to branding. It's all part of a success. And I always tell people, as many books will be written about Donald Trump and his presidency, I believe, as have been written and will still be written about Abraham Lincoln. Not to say that they're equivalent presidents, but they are that consequential, because the influence on American politics is so pronounced and so multi-directional, almost panoramic in its directional importance. And so for the next year, Republicans are going to have to decide on a couple of things. What is the dominant priority? To, in every way, shape, and form, say they cohere or adhere to a Trump approach to politics, or be a little bit more flexible and win more seats. Now, I guarantee you what Kevin McCarthy's priority is. It's to keep internal Republican primaries to a very minimum, under 10 if he can, but certainly not 50. He doesn't want to have a whole litmus test about the future of Liz Cheney and the GOP conference, because he knows that only matters inside the Beltway and in one congressional district, Wyoming's. It doesn't matter anywhere else. And he doesn't want House Republicans pretending that it does. So his priority is win as many seats as you can, get back the House Republican majority. Mitch McConnell's is, get back that Senate majority, which we lost in Georgia, because everything about that Georgia runoff wasn't what Mitch McConnell wanted that conversation to be, which was, hey, let's make sure that Kelly Loeffler and David Perdue are a check on President Biden's power. Why wasn't that the message? Well, because you couldn't say there was going to be a President Biden. Right. Because Trump wouldn't let you.
Stepped on yourself. But
so what do you do with that? So what's the practical political priority? And how do you navigate that in a world where you have a feeling that Donald Trump from Palm Beach is going to use PAC money and polling data to try to threaten primaries wherever anyone, from his point of view, transgresses? Somebody has to put on some big boy and big girl pants and say to Donald Trump, you're not everything. And we have other priorities. And one of them is resecuring majorities that, for better or for worse, were lost on your watch.
But so the Democrats have done a good job, and we talked about this a little bit too, of marginalizing their sort of fringe element. You've got the socialists and you've got AOC. They say some goofy stuff, just like the folks on the other side. But they've managed, maybe because they have a middle of the road sort of mainstream candidate, but they've managed to marginalize that stuff. Add some of their stuff to the agenda, but they're not running as socialists. They're not saying we're going to run the country as socialists.
No, they're not saying that. That's important. And I really do think that there is a kind of adult conversation the country ought to have, that the only two alternatives currently in American politics are Trumpism and socialism. They are not. And to the earlier discussed conversation about, well, what's going to be the state of the filibuster? What's Joe Manchin going to do? What's Kristen Sinema going to do? What's Mark Kelly going to do? And you throw into that conversation on the Republican side, Susan Collins, Lisa Murkowski, Mitt Romney, Pat Toomey, maybe even Rob Portman now. I mean, their world isn't socialism or Trumpism. Their world is, let's legislate some things that give a little bit here and take a little bit there and meld something that can get 60 votes in the Senate. So we have this false conversation, I think, that the only alternatives are these two great poles, Trumpism, socialism. And Democrats are going to have to decide how much of their agenda they want. And President Biden is going to have an enormously important role in that, saying, do I want to jam everything through and use reconciliation in every respect I can with slenderest majorities imaginable, which means it's not as durable and it's a hard fight the whole way. Now, trust me, strategic thinking Republicans want him to do that. Why? Because it'll unify Republicans much more rapidly. Yeah. Bipartisanship divides Republicans, and they're afraid of that. They don't want Biden to be really serious about bipartisanship, because they don't want to see their coalition, where it's fragile right now and trying to figure out what it wants to do, divided by a cagey legislator like Biden saying, hey, what if I give you these 5 things? Can I get 8 or 9 Republican votes, even if it's not 60? That's what Republicans are nervous about strategically. They would much rather Biden just bow to Bernie Sanders and say, ram it through on reconciliation, get the Democrats your vote you can, and Republicans say, oh, thank goodness, we're unified now because we hate all this stuff. So that's the next 6 to 8 weeks in Washington. What does Biden do on this question of his intensity and his desire for bipartisanship? One thing to keep in the back of your minds, everyone says, oh, Joe Biden knows everyone in the Senate. Just remember this. He served with 1/3 of the current Senate. But he has a mindset like Mitch McConnell, like him or not, and Joe Biden. They have a respect for the institution of the Senate. I mean, they feel it's a really valuable piece of what makes the country work. So I mean, you're starting off on a positive level there with guys like that. Some of the new people that came in, both Republican and Democrat, have less of a feel. They do. They have less of a feel for it, and they don't understand that. as Mitch McConnell has said, and others at the time, back when there was a power sharing arrangement, a 50-50 cut by Trent Lott and Tom Daschle, getting rid of the filibuster wasn't even discussed because the idea was, look, the filibuster is an important component part of the Senate. Remember, it's not in the Constitution. It's a Senate rule. It can be changed, but it's a part of the Senate history. Now, many would argue it has been so thoroughly used, and they would argue misused since that last power sharing agreement in the early 2000s, that it has to be reevaluated. It has to be recalibrated, because they would argue the filibuster simply can't be a Senate rule that essentially nullifies every midterm election that switches control of the Senate. Which,
but you know, when
not every midterm election does, but when there is a control shift, the filibuster ought not to be the minority party's cudgel to stop everything that was just won in the most recent election.
Well, the problem is, you talk about election has consequences and one, and he's going to try to shove through as much stuff as he can. I mean, this wasn't a landslide. As we said, there were a lot of ways to win this thing. So you're not really going with the majority of the American people, right, to say, well, let's just legislate. And you have to be fair, you got to kind of go back to Obama, who did a lot of that, but he was such a nice guy that you just, it's all right, let him do it.
I often tell people in the immediate aftermath of the election, if it was a conspiracy, it's the worst conspiracy in the history of politics, American or otherwise. Let's narrowly elect the president. Let's narrowly, by the skin of our teeth, win a Senate majority, but only after 2 runoff elections that cost about $200 million. Oh, and let's lose 10 seats in the House.
Right.
That's the stupidest conspiracy in the history of American or politics anywhere else. Oh, by the way, let's gain no state legislatures on the cusp of districting. I mean, it's a bad lot. And that's why Republicans feel fortified, saying, look, Trump was a problem. Trump is a huge problem in the suburbs. Trump is a big problem demographically with youngsters, anyone under 30. But still, and look at California, my home state. Look at the initiatives on the ballot in California. All of them on the progressive side, they all got thumped. Not because California is suddenly turning to a Republican state, but Democrats and progressives weren't all sold on them. So there were things to look at in that 2020 election that if you are a center-right Republican, you're saying, yeah, you take Trump out of the equation, much of the things we talked about resonated. And that's something that I know Biden will pay attention to, and he will urge those in his party who are on the progressive side to pay very close attention to.
You hope that they get to this making a deal point. I think people like divided government. We have so much of it. You know what I mean? Usually after these elections and coattails, we end up with a divided government, so that, the hope is, right, some checks and balances, come out. And
certainly. And look, you can't get it more closely divided than it is right now. I mean, if there was ever a time where the natural inclination ought to be bipartisanship, it's now. I mean, Nancy Pelosi has a much narrower House majority. Everything that she wants to do, if she can get some Republican buy-in, is easier to accomplish. And in the Senate, you just can't move. I mean, yes, Chuck Schumer will vote for it. Bernie Sanders will vote for it. But if Mark Kelly, Kristen Sinema, and Joe Manchin aren't for it, sorry, you don't even have a chance. Right. And I know Manchin very well, and I know his current chief of staff. And I said, the days of being the cheerful, bipartisan, hey, I'm here if you need me guy are over. Yeah. You're the fulcrum, and you better get ready for it. You better decide the 3 things you want and then make them happen, and stop playing games with like 15 wish list items. You're a fulcrum of power now, and you better learn how to use it, because the legislative hourglass is going to be running out of sand each and every day. And so the Manchins of the world, the Mark Kellys, the Kristen Sinemas, the Susan Collins, and trust me, don't think Susan Collins doesn't have some scores to settle.
Yeah.
Don't think that. And she was given up for dead by a lot of Republicans, and she's taken names and laying down some revenge. And if that means legislative coalitions with Democrats, I think she'll be wide open to them.
Do you see them getting together as a coalition? So you've seen that over time. I mean, look, there was a time when Tip O'Neill used to have lunch with Ronald Reagan all the time. Remember?
Yeah, but we're a little too dewy-eyed about that. They did have drinks. They did calm things down after hours, but during the regular hours, they fought like hell. And they were like the Social Security thing. Well, they were forced into it because it was an abject crisis. I mean, the clock was ticking on that, and everyone had to move. And because it was a crisis, everyone could hold hands and jump off the cliff. That's what a bipartisan deal is often made of. But I think when you look right now, how did the year-end stimulus deal got done? It wasn't Schumer and McConnell. No, it was Manchin and Collins and Romney and these others. And they held about 9 or 10 of them together. And they're now saying, you got to go through us, White House. You got to give us better data if we're going to give you anything you want on this next COVID relief bill. So I think they're acting like people who are a serious toll bridge employee. Like, no, the bridge doesn't, we don't do that. It's like this until we say it's like this.
Right.
And as I indicated before, they better understand that power is fleeting and use it to its maximum impact now.
Well, the other thing that the Democratic Party was thinking, and you and I had spoke about this earlier as well, our demographics, or is or are demographics destiny? Mm-hmm. What is it? You're the Townsend report. Is or are? Well, they whatever. Are they?
Demographics are. Data is. So anyway, whatever you thought about the trend lines in 2008 and 2012, and I covered both of those campaigns, and I well remember everyone in the Obama world saying, demographics are destiny, because these trends are not going to be reversed. And then Donald Trump came along in 2016 and said, yes, those demographics are real. He looked at the Republican Party autopsy after the 2012 election, drafted by Reince Priebus, by the way, that said, we have to do all these things to reach out to minorities. And Trump said, forget about that. White voters matter more, and I'm going to prove it. And in 2016, possibly for the last time, he proved that if in a election that has about 6% that's on an off-ramp for third parties, as was true in 2016, a very, very high percentage, and a deeply unpopular candidate on both sides, you'll have enough people sit out or go third party that the white vote can matter more than this other demographic set of trend lines. And he was proven right, albeit narrowly, but just enough right to become president of the United States. And then what did we have in 2020? We had massive turnout on both sides, huge turnout. And many Trump supporters said to themselves, how could we have so much more turnout and still lose? Well, when everybody turns out, or you have a turnout cycle that is as large as it's been seen in 100 years by percentage, and that includes a lot of voters who weren't even allowed to vote 100 years ago, you can have a tilt like we saw. Big Trump support boost, but also much bigger on the Democratic side. And that's what happened. And so for Democrats, they see places like Georgia and Arizona, and they will still focus on Texas, though Texas did not turn out to be anywhere near as close as many Democrats thought it would, as places where their growth opportunities continue to rise. And places like Ohio, kind of given up on that, maybe even Iowa, and Wisconsin, incredibly narrow, and Pennsylvania, tough. But real growth opportunities, Georgia, Texas, Arizona, and they would hope at some point, Florida. And if you begin to look at a map like that, and you say, wait a minute, you hold California, all the Pacific Northwest, New York, most of New England, Georgia, Arizona, New Mexico, Nevada, Colorado, Texas. Whoa, that's where Democrats think their future is. And Republicans need to be responsive to those trend lines. They need to look at Arizona and Georgia and ask themselves some very tough questions. Why did that happen? And the internecine fights going on in Arizona right now do not augur well for Republicans dealing with that, because they're cutting themselves up in full public view because they lost a state that they should have won or think they should have won.
But when you think about it, and maybe we're in different businesses, but you think about like the Hispanic vote, it's culturally a conservative vote. It's a religious vote. It's these are people who believe in the American dream. That's why they came here. This should all be Republican stuff on some level, right?
Right. And
can they get there?
And it's worth noting that ever so slightly, but not in an irrelevant sense, President Trump, as he grew his vote total from 2016 to 2020, increased by percentages, small but not insignificant, Hispanic vote and African-American support, indicating that sort of America First, strong economic populism message has some traction there. Was it enough to compensate? No, it wasn't. And it wasn't certainly by percentage enough to compensate for the loss of support in suburban America. The loss of support in suburban America was a significant problem for Trump, not for Republicans. Look at Pennsylvania.
Yeah.
Look at Pennsylvania. He lost the suburbs, and in those very same suburbs, Republicans split tickets as if they had only that choice. It's like Trump and then Republicans, statewide and federal elections. And that's a trend line that we haven't seen for a long time. We've usually been, because of the partisan reinforcement and the sense of polarization, all Republican, all Democrat. No, in a lot of places, but Pennsylvania is an excellent example of this. There was no on Trump, yes on Republicans. And that was a particularly Trump-focused problem. And everyone who wants to run in 2024 who's a Republican not named Donald Trump is trying to figure out, how do you walk that line of being a credible second act of much of Trump without being Trump and winning back those suburbs and picking and keeping that Hispanic vote and picking up that African-American vote Trump got and making yourself a true 51% of the popular vote Republican. Remember, Republicans haven't won the popular vote in a while.
Yeah, but you also got to, they won it also by paying attention to a group that was not paid attention to. I mean, I would not have expected those, I always, again, going back to the Reagan analogy, the Rust Belt was union workers. They weren't Republicans. And now they sort of are because somebody paid attention to them. You would think that that's an opportunity for the Democrats too. Just pay attention to these people. Give them a little love. Let's see what naturally they may want to lean towards you. I don't know.
Pay attention to these people and follow through. And so I don't think it's anywhere at all a coincidence that one of the early executive orders from President Biden is Buy American. Yeah. We're trying to figure out what all that means and what all the dimensions of that are, but he had prepared remarks around that particular executive order. Well, that's not a coincidence. That's talking about this aspect of Trump's approach to politics, which is, it was very anti-globalization. I don't think Biden is as antagonistic to globalization. He knows it's a reality, but he wants to shape it within the Democratic Party much more along Trumpian lines than you ever would have heard Barack Obama or Bill Clinton. I mean, I remember being in Ohio as NAFTA was being debated, and I saw and met union workers who were furious with Clinton and basically never gave him a second listen after NAFTA, just never did. Because they believed that was the beginning of the end of their livelihoods. And it wasn't just in Ohio.
Yeah. That's when you talk about like these things that are sort of these fractious issues. And you've heard some of the other speakers today talk about, how we can get there, how we may compromise, may not. We didn't get into it too deeply about the filibuster, because that seems to be one of the things that if it remains, you'll have checks and balances. Right. And if we don't have it, we're going to have a new agenda. Just what's your 2 cents on that? Where do you think that's going to go? What's your gut feeling on that?
So Mitch McConnell wanted Senate Democrats in the organizing resolution to commit in writing that there would be no attempt to get rid of the filibuster. That did not happen. That's what he sought. And what he had to say was, well, I've read accounts from Senator Manchin and Senator Sinema that they're not going to vote to repeal the filibuster. Therefore, I know it's safe. Well, that's different than Senate Democrats under the handwritten note or typewritten note that is signed by Chuck Schumer on a power sharing agreement saying we're not going to touch it. Those are two different things. And many progressives and Democrats fairly reading that say McConnell caved. Now, McConnell is not the person most likely to cave in scenarios like that, but he took this as far as he could. And he believes the filibuster is safe for now. And as long as Manchin and Sinema stay where they are, it is, because you can't move it without a majority vote. Mm-hmm. And there is real fire to be played with there. And Democrats have learned that. I was there when Harry Reid invoked the so-called nuclear option for the first time on lower federal court appointees and cabinet appointees. And Republicans said at the time, you will be haunted by this, because the next time this comes around, we'll change it on an even bigger agenda item. And they did. Supreme Court nominees. And so if the Senate goes to a simple majority vote to change the rule, then this will go back and forth. Or as the Senate changes hands, so will its legislative imperatives change hands, and there won't be the imperative to create bipartisan compromise. Now, I can hear progressives in my ears right now because they've been talking to me for this for 6 years. There is no bipartisan compromise anymore. Dummy. There is no legislative process that forces that 60 vote threshold. It only happens in a crisis. That's why we have government shutdowns and all that other stuff, because it only happens when no one has any other choice. And there is a body of evidence to suggest that's more true than not true. And I know Manchin wants to keep the filibuster alive because he wants to resurrect the committee process, where the Senate actually has bills go through committee, go to the floor, and have an open debate and amendment process. And if he doesn't get that, he may change his mind. So I think a lot of this stuff is very, very fluid. But the bottom line is, someone who spent 12 years covering the Congress of the United States, House and Senate, if you turn the Senate into a mirror image of the House, pure majoritarian rule, no matter what, you will fundamentally change the legislative process, and you will eliminate the ability of the Senate to act as it always has, as that place where the temperamental excesses of the House are cooled.
Yeah.
You'll have two
where there's debate.
Yes, exactly. And you'll have two places that have temperamental excesses. And I think we have a lot of temperamental excesses in American politics already.
Yeah. Well, actually, I couldn't agree more with that. Just as sort of a last, sort of couple bits here.
Mm-hmm.
We're worried about economic policy. You heard it, straight through. Everyone's worried about taxes. Some of these things could be, if you combined a state tax with, capital gains plus carried interest plus, all that stuff,
Mm-hmm.
you could end up with a 90%, so somebody who has a business. And of course, the practical problem is my dad has a successful plumbing business. I can't inherit. I have to sell it in order to pay the taxes on it. And, that's it. So the family legacy kind of goes away. Where do you think that kind of stuff ends up, with this group?
Well, I mean, you identified areas where the political resistance to raising those taxes is less fierce than it is if you raise taxes on the middle class. And, when I first came to Washington and I started covering Congress, that was back in 1990. And back then there was a fierce debate about balanced budget amendments and line item vetoes and all this stuff about, we're spending our children's inheritance, and the debt was running out of control, and budget deficits of like $400 billion a year were just absolutely unacceptable. What? Are you kidding? I mean, all of that has sort of become quaint and part of an antique part of American political dialogue, this obsessive worrying about budgets and debt and spending. Both parties are sort of in on that. And so they've kind of ceded the whole spending side of the ledger, and only the debate is at the margins over tax policy. Because remember, it was President Obama who made the Bush tax cuts under $450,000 permanent.
Right.
The radical liberal Obama did that, right? In the deal he cut with McConnell, engineered by Joe Biden to get the debt ceiling increase. So if that's radical leftist tax policy to make the Bush tax cuts permanent under $450,000, that means the middle class isn't going to be touched. Not only is the middle class not going to be touched, the upper middle class isn't going to be touched.
Yeah. So
what does that leave? That leaves estate tax, carried interest, cap gains, and corporation taxes. That's it. And until we change our philosophy, and I don't see anyone in the political spectrum raising their hand and saying, you know what, middle class got to step up a teeny bit. And until those happen,
when's that going to happen?
Until that happens, where else is there money?
Yeah.
And so the business community gets on this sort of tightrope of like, well, dang, we're always near the griddle.
Yeah.
Because we don't have an actual coherent policy debate in this country about taxing the middle class at any level or above where they currently are. And then that means states fill in because there's less money coming from the federal government. So these things that you've mentioned, all of which are uppermost in the minds of the business community, are always going to be there because we don't talk about raising taxes on the middle class.
There's nowhere else to go.
There's nowhere else to go.
Politically, there's nowhere.
Politically. No, there's plenty of places to go. But there's just no political will for it. And when I think about infrastructure, which everyone talks a good game about, and everyone understands the investment value of it, massive investment value of it, whether it's 5G or making sure that rural areas and underserved areas have the capacity to have the internet that is enjoyed by every urban area, or bridges, ports, all of that. Everyone knows the inherent investment value of that, everyone. And we don't want to raise a gas tax that hasn't been adjusted since the Clinton budget deal of 1993? Are you serious? We don't even want to inflation adjust that? Forget about a real increase in taxes. We don't even want to inflation adjust that.
Yeah, I mean, you would think a consumption tax ought to be something to everyone ought to be able to get behind one way or the other, because it's
precisely. But you need someone to say this is actually sensible, and anyone who tells you otherwise is scaring you to your own economic detriment, because we're a much better country, much better off country. If just to say, for example, let's say if there had been no digital divide before the pandemic. Let's just say that, is for sake of argument. How much better off would we have been to withstand the worst ravages for school-age children of the pandemic?
Right.
Much, much better. It would have cost us much less than it's costing us now. So much less.
You know, I just, in coming to the end of this conversation here and hearing what we heard today and talking to you, I mean, you know, words matter, right? So, you know, you look back on, we talked about Obama, you know, using the presidential power and signing stuff, and then Trump tit for tatting doing the same. But there was a different tone. And as much as a lot of people, you know, I certainly think Trump's tax policy is better than like whether have cut taxes or not. But, you know, the rhetoric was rough. And you end up with people storming the Capitol. Rhetoric on today with Biden is all about reconciliation. And I think you could have made an argument that you talked about the past, that at some point the president used to not have a lot of power, and there was not a lot that he could do. You know, he needed to have the Congress with him. He could set a tone, but really all he had was the words. And the words are really negative at the end of the Trump thing. And, you know, maybe that's what cost him. You know, I think a lot of people that voted for him held their nose and voted, right? Still could have won. But the words coming out today are about, you know, bipartisanship and working together. That's got to have some impact, because people are enjoying that part of it. And if words matter from a president and you're setting the tone, you know, maybe they will compromise on some of this stuff.
Yeah, it as the president said earlier this week in a, I thought, laudable moment of candor, and it wasn't an accidental. He was actually explaining something that he knows well. He said, in a legislative compromise, people hold their positions until there's no other alternative.
Right.
That's exactly right. And he knows that well. Joe Biden was among the more effective legislators on things he really got his back and shoulders into when he was in Congress. That wasn't everything. It was most things he didn't. But like on the crime bill in 1995, which I know 20 years later is viewed more harshly than it was at the time. But at the time, it was considered a signal legislative achievement, really hard to put together. And he's right about that. Everyone holds out until they know two things. This is going to happen, and your alternative window is about to close. Okay? And what he was, I think, signaling is, I'm going to make a bid for bipartisanship on budget and this idea of a pandemic relief part 5, because we've already had 4. But it'll be my first. So my pandemic part 1. I'm going to give this a chance. But you know, I've got reconciliation in my back pocket. And I could probably go to Chuck Schumer and have him have a long heart-to-heart with a Senate parliamentarian, and have that Senate parliamentarian come around with the idea that raising the minimum wage from $7.50 to $15 an hour is permissible under reconciliation instructions. And if you're scared of that, that's my back pocket. And that's your alternative. And that window is going to be open for 6 weeks, 5 weeks, whatever. But when I close that window, it's closed.
Right.
So let's talk. And I'll give and take, and I'll show you my data. And if you have data, you want to come back at me, fine. We'll keep an open dialogue. We'll run it back and forth. But the window will close, and this will happen. And that's when legislative deals are struck. And so that moment of candor, I think, was very instructive. It was his 1.5 sentence roadmap on this. And I think with the executive orders so far, he has tried to do things with the pen to tell progressives, I hear you and I'm with you. But on the biggest things, I'm going to cut the deal because I'm president and you're not. And we'll see where it goes.
Well, I'm going to leave it at that. It's great stuff. Really appreciate you giving us some perspective on these things. And it was great talking to you. Hopefully we'll talk to you. Hopefully we talk to you again. And really think about it. Tell your bosses at CBS you got a phone coming your way if you come over here, because that might get some movement for you on your next contract.
Exactly, guys. They're going to give me a cell phone. Can you believe it?
That's right. All right, speak up for yourself. Don't.
And
be
in
so
year
shy.
three, I get earbuds. Okay.
Well, I didn't say that, but I did say the phone. So the earbuds we can talk about once you're here. We'll talk about the earbuds.
Very good.
All right, take care.
Farewell from my dining room. See you later.
Take care.